Mohamed, interestingly, the market seems to be hoping a little bit more that the Fed has got its back once again. There seems to be rumours and momentum building behind the view that the Federal Reserve might pause come 2019. Is the data bad enough for that? Do you abide by that viewpoint?
Not as yet. This is a different Fed, and I think the markets have to realize this. This is a Fed that's seeing its economic signals still point to further hikes. This is a Fed that is worried about financial instability down the road, so wouldn't mind taking some steam out of the excessive risk-taking. And this is a Fed that's not convinced about the spillbacks from the rest of the world onto the U.S. economy. And don't forget that this is a Fed that also wants to show that it's politically independent. So I think that it's going to take a lot more for the Fed to pause considerably. They may pause on one hike, but I think the market is hoping a little bit too much. You need to see a weakening in U.S. economic indicators before the Fed pauses.
Right, and we're not there yet. But as you point out, it's a different Fed, and a lot of that is because of who's at the helm, which is Jay Powell. Different, certainly, in how he communicates than his predecessor, Janet Yellen. Of course, a lot of people say that his comments regarding U.S. rates being well below the neutral rate was what sparked the October sell-off. Since then, Clarida and some other Fed officials have come out to kind of maybe walk that back a little bit. What is your confidence that the central bank will not be behind the curve here in this different Fed formation?
So I think the balance now has shifted to the balance of risk has shifted from the Fed being behind the curve in hiking, which was the case starting in 2015, in my opinion, to the possibility of the Fed over-tightening. So the balance of risks has moved, and the Fed, I think, is aware of this. And you're right. Rich Clarida, the vice chair, moderated the signal that the chair had given just a few days earlier.
I'm interested in your perspective, and when we see these bouts of volatility, Mohamed, where you go for a safe haven right now, because you've only got a certain amount that really yields can fall once again on US Treasuries, given that rate hikes are still anticipated to a certain extent. Gold doesn't seem to move in that direction. Where are you? Is it all about cash at the moment? How do you ensure that your portfolio is best placed in these times of volatility?
So it depends how sophisticated an investor you are. If you are the retail investor, then it is about being in cash or at the short end of the curve. Up to 2 years, you're safe and you're actually getting paid something, which is a change from quite a few years. If you're a more sophisticated investor, I think you have to seriously think about tail hedging, about the most efficient way to do so. It used to be very cheap because volatility was so low. It's now not as cheap as it was. But I think for the retail investors, it is short-dated treasuries and cash, and that gives you something very important, which is the optionality to pick up good names at cheap prices. Because when we get these technical dislocations, as you both know, then it tends to be indiscriminate, and you do tend to get good quality names trading at cheap prices.
Okay, what if you want to take risk, though? What if you think that now's the right time to move beyond being cautious and defensive? Where would you go for that? Would it be overseas in emerging markets?
So I wouldn't go yet to emerging markets. I think quality and liquidity matter. I would have two principles. One is you want to take risk actively, not passively. So this is not the time to pile into passive products. It really does matter how you differentiate. So that's the first thing. And second, know yourself. Know whether you are willing to underwrite significant volatility. You know, this is a fundamental change in the liquidity regime. So volatility is going to stay with us for a while, and the worst thing you want to do is end up being forced out of a trade because you simply couldn't stomach the volatility.